Okay, good morning, students. So today we are going to continue our discussion on chapter 1. We have 4 more topics for today. So 3 forms of business organization. So we are going to show you 3 forms, all right? And please know you need to understand them and then make a comparison between them, all right? So here is a summary. So we have 3 forms, not difficult to understand. Sole trader or single owner, partner, 2 or more owner. Finally, we have the company, all right? So I use an example to remember the 3 forms of business, right? So for the single owner or the partner, I'm thinking a small business, like a $2 shop, all right? It's a private or unlisted business, all right? On the other hand, company is a large business or public business or listed business, right? For example, like a Yahoo, Google, or Apple, all right? So for me, it's not difficult to understand. Small business, right? Large business like company is a listed business, all right? Later, we are going to discuss the advantage and the disadvantage for each form of business. The idea is simple. Advantage of small business will be disadvantage of large business and vice versa, right? So please remember, make a comparison between them. So business owner need to choose the form for their business to maximize the value of the business entity. So this is a goal for the business owner, maximize the value. And here we list some considerations like a size, tax, legal liability, and ability to raise cash for finance. We are going to discuss then this consideration in more detail later. So next. So we discussed the single owner business first, right? So you can see owned by one person. And I use the symbol plus to represent advantage, all right? Negative symbol is the disadvantage, right? And remember, advantage of small business will be disadvantage of large business, all right? So you can see advantage here, least regulated, right? And keep all profit and don't need to share the decision, right? But unlimited liability for small business, right? About this, I like to use an example to show you the idea in a simple way. So for me, family is a business. So I use my family as an example, right? So this is my balance sheet, right? So I raise my money by debt and equity, and I buy a house asset, for example, $500,000, right? This is my T0, for example, today, right? Let's say 1 year from now, T1, I go bankrupt, right? Unfortunately. And my house value, the asset value dropped to $200,000, right? My debt is still $300,000. And you can see now my equity is negative $100,000. That means I owe $100,000. I need to use my own money to pay the debt because the family is a private business, right? The debt is unlimited, all right? Later on, we will make a comparison with the company. You will see for company, their liability or their debt is limited, all right? Again, you have to remember here we are discussing a small business or non-company business. Advantage of non-company business is a disadvantage of company. So partner, so single owner to partner. So you can see partner, like we have two more owner, right? Again, family is a business. So I'm thinking before marriage, single owner. After marriage, two owner, my wife and I, right? So it's very easy to understand. So and the advantage, more capital, but dispute between owner, right? Like sometimes I will fight with my wife, right? So you can see it's easy to understand. Next, we are going to discuss the company, right? So company like Apple, Google, right? It's a big company. So it's a legal business, it's a legal entity, and the separation of ownership and the management. That means owner, they are shareholder, right? They are shareholder are owner, but manager, right? CEO, and you can see the separation between them, right? It could be advantage or disadvantage. Later on, we will discuss the later, right? The advantage, like a family. Let's compare family. Family is a small business. I'm the owner. I'm also the manager, right? This could be an advantage, right? Because I can make a decision on my own, right? And I consider my own utility. Right? However, separation of ownership and the management for company, you can see it could be advantage. That means company can hire professional manager to run their company, right? However, it could be a negative, disadvantage, agency problem. Later on, we will have more discussion on agency problem. It's a very important issue in finance, all right? Next point is limited liability for company. This is an advantage for company. So again, let me use my handwritten note to show you the idea in a simple way. So this is the time balance sheet for the business. All right. So T0, 1 year from now, the business go bankrupt. Right. If the business is a company, you can see the equity has a flow value 0. All right. That means 1 year from now, the company go bankrupt. They sell their asset, pay their debt, $200,000, for example. That's all. All right. Equity investor don't need to pay the debt using their own money. Right? But if this business is a private business, for example, my family, I have to use my own money to pay the debt. Right? So this is the limited liability versus unlimited liability. All right. So next one, professional manager but agency problem. So this point is about separation of ownership and management. So advantage for the separation, professional manager. This is positive, but agency problem. We will discuss agency problem later. Public company can list on the stock exchange, so they can issue stock to raise the money, right? Like to sell a part of their company in the market to raise the money, right? This is an advantage, okay? But family, I cannot, I cannot sell my family to any other. I cannot say, okay, you can use my family 2 days a week. No, I cannot do that. It's a private business. I'm an owner, all right? Finally, company are difficult to start and more regulated. To be a company, company need to follow a lot of regulation, right? But we don't need to understand the detail, right? Like, for example, they have to report their financial statement to the public regularly, all right? So we finished the topic, 3 forms of business organization, right? For me, what I remember is small business versus large business or public business, right? You need to understand advantage and the disadvantage for each form of business. Next one, agency problem and the control of corporation. So what's the agency problem? The agency problem is due to the separation of owner and the manager. So for the company, you can see the separation, owner and the manager, right? So owner, they are principal. So principal hire an agent, that means manager, to represent his or her interests. Right? So stockholder or the principal hire manager to run the company. And then you can see the separation between principal and the agent. Then we have the agency problem. There's the conflict of interest between principal and the agent. And because of the conflict, we have the agency cost. Right. So again, let me use my handwritten note to have more discussion about the agency problem. Right. So first, we'd like to highlight the management goal. So the goal of manager should be to maximize the wealth of the stockholder. Right? For stockholder, their concern is the stock price. Right? It's the manager's goal. However, we can see the conflict between manager and the owner. So let me use myself example again. For example, a house. I'm a house owner. I'm the principal. Right? If I want to sell my house, I will hire an agent. For example, real estate agent. And you can see the conflict between me and my real estate agent. For example, I'm a house owner. I want to sell my house at the higher price, as high as possible. All right? But my agent, his goal is to sell my house as early as possible. So he wants to sell my house at a lower price because it's easy to sell. Right? Then you can see the conflict between owner and the agent. All right? So next slide, agency cost. Here, go back to company. So company, we have manager, but owner, they are shareholder or stockholder, right? So we have agency cost. So we need to make sure manager is doing or run the company well. So we have the direct agency cost. That means monitoring cost. So owner, they need to hire, for example, hire the accountant and the auditor to monitor manager. All right, this is the direct cost. And indirect agency costs mean manager, they will focus on their own personal utility. Here we give you some example. All right. So here I have two questions for you. So which cost is more serious? All right. For me, indirect agency cost is a big problem. Right. So manager, they just focus on their own utility or own interests. All right. We have more examples, like a government. You can also see the agency cost or agency problem. So country, we are the owner. Citizens are the owner, right? Government officer, they are the manager, right? So government officer, they might just focus on short term. They have their turn. They focus, but for our view, we focus on long term, right? Unit, you can see in the unit, we can also see the agency problem. So student, you are the owner of the unit, university, right? Lecturer, right? Or PVC or vice chancellor, they are the agent, all right? So you can see the agency problem. So which cost is more serious? Indirect agency cost is more serious. And the the question is how to mitigate the problem, how to solve the problem. So later on, we are going to discuss the solution to the agency problem, right? So two solutions. One, managerial compensation, or incentive compensation, right? So we incentive payment. We don't give manager cash. We give them stock or stock option, right? So this incentive payment can be used to align management and the stockholder interests, all right? Their interests will be together, right? So again, my handwritten note here, because now you give the manager stock or stock option. So for CEO, their focus will be stock price. When stock price is going up, their compensation will go up. And you can now see the alignment, right, between manager and the owner, all right? Stock option is a very special product in finance. So for example, call option. Call is a right to buy, right? It's a right to buy. In the call, we have the exercise price. So here, that means the option holder, they have the right to buy the stock at the exercise price. Let me give you an example. For example, the stock price today is $100 per share today. And we give the manager the stock option, call option, with the exercise price $110 per share. So manager, they can buy the stock at 110, all right? But in the market price is only $100. So you can see the option today is out of money, no value, right? So if you are a manager, you know your exercise price is 110. Your goal is to higher the stock price. For example, the stock price higher go up to 120. Then your payoff will be 120 minus 110, $10. So you can see the stock option will be an incentive to the manager. You know, they will do their best to rise up the stock price. Okay, so this is a first solution, incentive compensation. However, the incentive need to be structured carefully to make sure they achieve their goal. I mean, incentive payment might have some problem with the stock option, right? Like a risk taking. So manager will take more risk, higher return. But too much risk could be a problem to the company. And earnings manipulation. So manager, they might cheat, right? They might change the accounting number, cheat the market, and to rise up the stock price. This is another problem, all right? The second solution to agency problem is a voting right. So owner, those shareholders, they have the right to vote their manager, right? This is another solution. So the threat of takeover may result in better management, right? Okay, we finished two topics. We have two more. So we have discussed three forms of business and the agency problem. We also discussed the solution to the agency problem. Now our next topic is financial goal of a business. So for business owner, it's important to determine the appropriate goal for financial management decision, right? So in our early discussion, I mentioned that for business owner or company owner, right, shareholder or stockholder, their concern is the stock price. right? Stock price is the value of the company. So their concern is to maximize the stock price. So what should manager maximize? So our conclusion is the stock price. But we also understand there are many goals for a business, right? Although we focus on stock price, but I know in management, you have many goals. Here I give you some example, right? So we have many goals like a profit, cost, market share, or reputation. But this goal might have some problem. So in finance, our goal is simple: stock price or the share price of the company. All right. For example, profit. Later on, we will show you the problem with accounting profit. Right. So in finance, we don't like accounting profit. Right? Although people talk about accounting profit, but later we will tell you the problem with accounting profit. Minimize costs, right? Minimize costs could be a goal, but you know, cost down has the problem with poor quality, right? And maximize market share, right? It's good. However, to maximize market share, you need to lower your product price, and lower product price could be a poor quality, right? Reputation is a goal. However, reputation is not money. So, right. So in finance, our goal is to maximize the share price or the stock price. We like to have more discussion on profit. Why not maximize profits in finance? Because in finance, we want to point out the problem with accounting profit. So first, it's hard to define the profit. So profit or income is not equal to cash flow. And the profit does not consider the timing of the cash flow. So in finance, time is important, right? The idea is today's $100, $100 10 years from now, they are different, right? But in accounting profit, they don't consider the timing of the cash flow, all right? And finally, the profit ignore the uncertainty or the risk. So again, let me show you my handwritten note. I like to have more discussion on accounting profit and of course the problem of accounting profit. So profit is sales minus cost. Please note, profit is not our cash flow. 3 reasons. 1, sales. We have credit sales. All right. So in accounting, they can recognize the sales, although they have not received the money. All right. So we have credit sales in this here. And the cost, again, we have credit purchase. And depreciation is another problem. So in accounting, they use the depreciation to recognize the cost for the long-term asset. Okay, let me give you an example. I have two costs here. One is a computer. I buy a computer, all right, or laptop. Another one is dinner. I buy my wife a luxury dinner for our wedding anniversary. You know, it's very important to make my wife happy. So I spent $1,000, for example, for a computer and for the dinner. In finance, they are the same. 1,000 negative means outflow. But in accounting, they will be different. All right. In accounting, computer is an asset, right? It's an asset. So then they use 5 years to recognize the cost because the computer can be used for 5 years. All right. So in accounting, they use the depreciation to recognize cost. So 1,000 divided by 5 years, $200. So they recognize $200 as a depreciation for the computer over 5 years. All right. So you can see in accounting, they will spread out the cost over several years. All right. So and you can see the difference between cash flow and the accounting cost. All right. Oh, by the way, I like to make a joke on this. Right. My wife, when I talk about the example with her, she say it's not fair to her because she has been my wife for 20 years. So the dinner cost should be 1,000 divided by 20. So we should spread out the cost over 20 years. But my wife mentioned a very interesting issue. This is a earning manipulation. So manager, they can manipulate the accounting number. For example, if they are losing the money, they can recognize the loss is the investment for the long-term asset. Then they can recognize the loss over multiple years. Right. So this is accounting earnings problem, right? Earning manipulation. Right. So this is why in finance we don't like to use accounting earning. We will focus on cash flow. Right. So you can see in finance, our goal is to maximize the current value of the company share. That means the share price. This is a goal in finance, right? And the share value is determined by the future cash flow. So in finance, our focus is the cash flow and the cash flow in the future, right? When determining the value of company share, the below should be considered. That means the share value will reflect the size of the expected cash flow, the amount of the cash flow, the timing of the cash flow, and the risk of the cash flow. So in finance, we think share price is the best goal because the share price will reflect everything, all right, including size, timing, risk of cash flow, even reputation, right? So all of them will go to the share price, all right? So we will have more discussion on the share price in chapter 2, right? We will discuss the market efficiency. So if the market is efficient, the share price will reflect all the information, right? And the share price is important to shareholder. So share price is the biggest concern of the shareholder, all right? So this is why in finance, we focus on share price, okay? Share price is everything. Okay, so because share price is very important for finance, so can management decision affect the share price? The answer is yes, right? They can affect the share price, but share price will be affected by other factors, not only management decision. So there are a number of factors can affect the share price. So management decision just control only some of them, right? So so we can see we have direct, indirect impact, long-term, short-term, internal, and external. Let me give you the next slide. You can see the share price is our goal, but there are many factors that will affect the share price. So you can see overall, you have the company factor and the economic shock factor. Right. So again, let me use my handwritten note to show you the idea in a simple way. So share price or stock price is our goal or is our most important concern. But the share price will be affected by the firm or the company, right? And by the economy or the market. All right. So think about that. If you are the company manager, your goal is the share price of your company. The share price might change due to your company, yourself, right? And due to the market. I mean, for example, now we know the market is not very good. It's very unstable, right? So your company is good, but it doesn't mean your company share price will go up continuously because we have economic shock, right? So this is the systematic factor, right? So systematic factor is the factor will affect all the companies in the market, right? On the other hand, the company itself, the company decision is an unsystematic factor. So manager can only control the unsystematic factor, right? But the systematic factor is important, and the manager could be unable to control, right? I can give you more example about the systematic factor versus unsystematic factor. So not only the company, for example, students' performance, you can see we have two factors. One, student themselves, unsystematic factor, your effort, your engagement. But the other factor is lecture. Lecture is a systematic factor. The systematic factor will affect all the students in the classroom, all right? So I hope students, you can understand the two factors. For me, unsystematic factor versus systematic factor, right? So manager, they can only make the decision themselves, management decision, but the market, systematic factor, they are unable to control the systematic factor, right? For example, Donald Trump is a systematic factor to everyone. We cannot control him. He's too powerful, right? So what we can do is do ourselves, all right, and make us stronger to survive in the debt market, all right. All right, we finished the discussion on financial goal of the business. So for me, I know financial goal of a business, the share price, right? And I know systematic factor and the unsystematic factor, the difference between them. We have one more session is a financial management decisions. So for financial manager, they have 3 decisions. So they see the 3 decisions. So financial manager is responsible for making finance decision. And their goal, again, is to maximize the value of the share price. All right. But here, of course, we have an assumption here. We assume share price will reflect all the information, including amount, timing, and the risk of the cash flow if the market is efficient, right? We will discuss the market efficiency in chapter 2. So on this slide, we show you the 3 fundamental decisions for financial manager. 1, capital budgeting, to identify the productive asset the company should buy. All right. So again, when I think about the finance issue, I would like to use the family as an example. So for me, family is a business, right? So productive asset is a long-term asset. So long-term means the life of the asset is higher than 1 year. Short-term, the life of the asset is shorter than 1 year. All right. So in finance, we use a 1 year, like a threshold, long-term, short-term. All right. So for me, capital budgeting is to determine or to identify the productive asset or long-term asset that the company should buy. For example, for me, my family, capital budgeting like the house. House is a long-term asset. All right. So I need to determine which house to buy. Again, car is another example, right? Or computer is another example. So this is capital budgeting. Identify the productive asset to buy. Next, financing decision. Determine how the company should finance for the asset, right? So again, example like a family. So when I buy the house, I need to determine debt or equity, right? Equity means my own money, all right? So should I use a debt or equity, or the percentage on debt and equity, right? Finally, working capital management decision. So when I say the working, mean short term. So in addition to long-term asset, we have short-term asset. So working capital management is to determine how day-to-day financial matter should be. So again, example, family, right? So short-term, shorter than 1 year. Example like a credit card payment. For me, credit card payment is, the period is 1 month, all right? And it's a good example for working capital management, right? Like my salary, I will receive my salary every 2 weeks. Again, 2 weeks, short term, right? So how to make sure my salary can match my credit card payment, right? This is a working capital management. So on this slide, we give you the balance sheet of a company and use the balance sheet to explain the 3 finance decisions. Right. So you can see in the balance sheet, we have 2 columns: asset, liability, and equity. All right. So for the asset column, you have the current asset, long-term asset. So current means short-term, right? Short-term asset. And the current asset include cash, inventory, and account receivable. Long-term asset, we have tangible long-term asset and intangible long-term asset. So tangible asset means like the building, like the computer, right? They are tangible asset. Intangible asset, example like a quality of employee, all right, or the trademark of the company, like an Apple, Toyota is a trademark. It's very important. It's a high value asset, right? So the decision on long-term asset is a capital budgeting. And how to finance the long-term asset? We can use the long-term debt or equity. This is our financing decision, all right? So again, let me use my handwritten note to show you how I remember the balance sheet. For me, this is my way to remember the balance sheet. So balance sheet will show me how the money is raised. So we can raise our money by CL, current liability. Again, current, short-term, right? Short-term liability, or long-term debt, or equity. How we use our money? We use our money on the asset. We have CA. CA stands for current asset. Again, current means short-term asset. And fixed asset. Fixed asset is long-term asset. All right, long-term asset. Okay, so you can see 3 finance decisions in the balance sheet. Capital budgeting is to deal with the decision on long-term asset. Financing decision is deal with the decision on long-term debt versus equity, right? So chapter 10, we are going to discuss capital budgeting further. Chapter 12, we will discuss financing decision. For the short term, CA and the CL, the working capital management. We have chapter 11 for this issue. All right. So again, family is a good example. So for my family, I know I have these three decisions, right? So when I buy a house, which house I should buy? Capital budgeting. How to finance my house? Financing decision, right? Manage my short-term asset and the short-term debt. This is the working capital management, right? Okay, we finished the discussion on chapter 1. We'd like to go through the 4 topics we have discussed today. First, the basic form of business structure. So you know the 3 forms of business structure. Right, here is a summary. Right, so we have sole trader partnership, right, for private business or small business. And the company is a public business or large business. And I know the advantage and the disadvantage for each form of business. And this is the point. Advantage of small business will be disadvantage of large business, all right, and vice versa. Second, we discuss agency problem. So I know what is an agency problem, and I know the cost of the agency problem. We have direct cost and the indirect cost. And the solution to the agency problem, incentive, compensation, and voting right. And I also understand the problem with the incentive compensation, including risk-taking behavior and earning manipulation. All right. Our next topic is a financial goal of a business. Right. So we have many goals for business, but in finance, our focus is a share price. Why we use a share price? Because share price can reflect all the factor, right? Everything, right? And why not use a profit? I know the problem with the accounting profit, right? Accounting profit is not cash flow, and accounting profit will not consider the risk, okay? And I know the factor that will affect the share price, including systematic factor and non-systematic factor. Finally, we discussed the 3 financial management decisions. Right, we have capital budgeting, financing decision, working capital management. And I know how to link our balance sheet with the 3 finance decisions. So balance sheet, you can see how the money is used, how the money is raised, and you can see the 3 financial decisions in our balance sheet. Okay. Before we go, we have to recall our attendance. Please give me a minute. I will show you the QR code. Give me a minute, all right? Okay. So online student, I also share the QR code with you. Hopefully you can see that from your end. Okay. Okay, so if you finish your attended recording, you are free to leave. I will see you next Tuesday.